Good morning, everyone, and welcome to the next session. We're joined here by the manager of Shires Income, an investment trust which aims to generate a high regular income via a portfolio of primarily large cap UK equities. Like all funds which depend on dividend payments from UK companies, Shires Income had a tough year in 2020 as the COVID crisis put the brakes on the economy, and many companies, even the biggest, stopped paying dividends. Things began to improve in the autumn, however, and the manager thinks the UK equities as an asset class, which are historically cheap, are well positioned for a recovery, particularly versus Europe as the continent continues to struggle with the vaccine rollout. Against this backdrop, Shires, which is trading on a much wider discount than most of its peers, is in an interesting position. And I'll now hand you over to the manager, Iain Pyle.
Good morning. Thanks very much, Pascal. Thanks to everyone joining for taking the time to listen today. So today, I thought we'd talk about two investment trusts, Shires Income and Moe Income Trust. I'm the lead manager, as Pascal says, on Shires Income, and I'm the number two manager on Moe Income. And hopefully talking about two of them won't be too confusing, but both of these trusts have certain characteristics in common that we think are really important right now in markets. So a good chance to talk about them and tell the story. What I'll do is just give you a brief introduction to the trusts, and then talk a little bit more about the team that sits behind them and why the approach we think is one that really works right now. And then we'll talk a little bit more about markets over the last year, how the trusts have fared and what we've done, and then hopefully I'll spend most of the time on what we see in markets right now and looking forwards before we get onto the Q&A. So before I introduce the trusts, I thought I'd start by introducing myself. I have been with Aberdeen Standard for the last 6 years. I've managed Shires Income since 2018. And before joining ASI, I was a sell-side equity specialist in the oil and gas sector. As well as managing a range of other income trusts, I also have sector responsibility in the UK team for looking after banks and oil and gas. The gentleman below me on the slide is Charles Luke. He is the lead manager of Moe and my number two on Shires. And he has over 20 years of investing experience. He's been at ASI for 20 years and is a gentleman who obviously brings a lot of wisdom and experience to the team. Now, the two trusts, starting with Shires. So the aim of this investment trust is really to deliver primarily a high level of income, but we aim to combine that with the potential of growth for both income and capital. And we aim to get that from a really diversified portfolio. It is primarily a UK equity trust, but it aims to differentiate itself in four ways. Now, the first of those is that it has about 30% today of the assets in very high yielding preference shares. And they're a great asset because although they don't have the same capital growth potential as equities, they deliver a really high, stable level of income. And that's important from a portfolio construction viewpoint because it allows us to hold some more growthy equities as well, where we're slightly less worried about the headline yield. We also hold select overseas equities, which give us diversification and also give us access to some things we might not be able to find in the UK market. We hold a position, currently about 15% of the assets, in the Aberdeen Smaller Companies Income Trust, and that gives us access to some higher growth, smaller companies using a specialist small companies manager with a very strong track record. And then finally, we just enhance the income with a small option writing program. The aim is that we get from the trust an above average yield, and we also keep that potential for capital growth. The next slide just kind of shows what we're trying to achieve with Shires. And what you can see here on the chart is the UK equity income trust sector. On the y-axis, you've got the net asset value return over the last 5 years. And on the x-axis, you've got the dividend yield of each of the individual trusts. What we're trying to do with Shires is really positioning it towards the right-hand side of that chart. So we want a dividend yield. We want to provide income that is really compelling above the market level. You can see at the moment, the dividend yield on the trust is 5.5%, which compares to the benchmark at about 3.3%. So it really is an attractive level of income. What you've seen over the last 5 years, is that generally those trusts that have paid out more in dividends have grown net asset values less. And it's quite self-explanatory. If trusts are paying out more, it's hard to grow NAV. But it's also a function of the fact that markets have been heavily skewed towards growth stocks over the last 5 years. So value and yield as a style hasn't performed particularly well. It's been tough to deliver that combination of both income and capital growth. what we hope to do with Shires is by having that slightly diversified construction, we try and get the best of both worlds. And we try and deviate away from that trend line up towards the top right of the chart. And the track record would prove that it has worked pretty well over that period. Moving on to Murray, you can see where Murray sits on that chart as well. It is a slightly lower headline yield, but still a decent premium to the index. And it's actually delivered slightly better capital growth over that period of time. If we were to sum up what Murray does, it is more of a straightforward equity income trust. It invests in equities, but it does diversify by having some overseas holdings up to 20% of the assets, and it also has an option writing program to enhance income. Where it really tries to differentiate itself is by having a very strong focus on quality companies and delivering a really dependable, resilient level of performance over time. So it takes a very long-term view to investing, and it differentiates it with that quality exposure and by owning companies which will be really resilient through a downturn. If I was going to sum up the outcome we're looking from Murray's, it would really be this chart here. And it's, in all honesty, a pretty amazing chart, 47 consecutive years of dividend growth. And we very much manage the portfolio in order to try and deliver that trend going forwards. So now I'll talk a little bit more about the philosophy behind the two trusts and some of the commonalities they have. This slide tries to kind of do all the high-level bits about what we think draws these trusts together and makes them their real characteristics. So in terms of what we invest in, we're looking at large and mid-cap exposures from primarily UK equities. Both of the trusts have a very strong mid-cap bias, which I think is where we as bottom-up stock pickers can add more value. The income in both cases is augmented by a fairly low-risk option writing program. And both trusts also hold overseas holdings. Like I say, they add more diversification and they give us access to things we can't necessarily find in the UK. In terms of risk management, both trusts have a very strong ESG focus, and I'll come back to that later. They both invest in what we define as quality companies, and we both try and deliver a portfolio which is really diversified by sector and provides a diverse set of sources of income. When we think about the philosophy, both of them share a long-term patient buy and hold approach, so relatively low turnover, and we're trying to buy things that we want to hold for a 5 to 10 year kind of period. Both of them over time have delivered a very strong performance track record, and both of them have a really important characteristic of resilience in market drawdowns. They both perform well when markets are going down and prove to be very defensive, which is an important thing if you're looking for that stable source of income. I've mentioned quality companies a few times in the presentation already, and it's something that when talking about Shires and Murray, I will keep coming back to. Quality for us is really important in the companies we're investing in for a number of reasons. Firstly, it helps companies avoid the tail risks that you see in lower quality companies. It gives you a greater margin of safety as an investor. It certainly produces less volatile earning streams and earnings that are more resilient and sustainable, and that's important when you're thinking about also delivering a sustainable source of income. And companies which we define as quality can better navigate uncertain times, and we've certainly seen that over recent years when you've had a number of large macro political effects that have moved markets around. Quality in itself is something of an ill-defined concept, I think, but hopefully the chart on the right just shows you what we look for and what we would define as a quality company. The most important things are a good business model in an industry we see as attractive, so high barriers to entry, and if you like, a right to make money in that industry, a reason to protect market share and to grow. Strong financials is important, so a strong balance sheet, but we also look at the margins the company makes and the return on capital it can deliver. We want to see good, capable management with a good track record, and also companies that score well on environmental, social, and governance risks. Because when you're investing for a longer term time horizon, these things become very important to understand and to appreciate. This slide just shows you the UK equity and the ASI that sits behind both these trusts. And what you can see is just 15 faces on a page, which tells you one thing, that it is actually a very well-resourced team. And in this case, actually, size is important because having a strong, well-resourced team gives us the ability to cover the entire FTSE 350 benchmark, and it gives us the ability to have sector specialists covering every stock. That's really useful from my point of view as a portfolio manager because it means we have the best chance of finding the right opportunities, the right quality income stocks that can go into these portfolios. It also means that we always have someone watching every stock and very focused on the changes. And if we see things like quality deteriorating or our performance with a company getting worse, then we're alive to that and we can move out of stocks with hopefully greater efficiency. That team is backed up, of course, by an central ESG team, a quant team, and all the things you would expect from a large investment manager. And as a PM, it's definitely a benefit of working somewhere like ASI. And of course, we have that same structure replicated in our US teams, emerging markets teams, and continental European teams. So when we are looking at overseas equities, we have plenty of options to go for. I wanted to touch very briefly on the approach to ESG. I think it's something that's increasingly important for all investors, not just ethical or responsible mandates. And it's something that I think at ASI we do very well, but we probably don't communicate as well as we could do. And I think the reason for that is ESG is something that's really built into our process and integrated into it. We don't have a headline-grabbing policy of excluding certain stocks from funds, but what we do is put the ESG analysis with the sector analysts. So every analyst has to take a view on the ESG factors and qualities of a company and score it appropriately. And that makes it very central to each of the investment cases for each stock. That's important for us because understanding the ESG risks and opportunities really gives us better insight into the financial metrics and financial forecasts for our companies. And as well as the sector analysts, they are very ably supported by an on-desk ESG specialist and by a central ESG team we have of 20 individuals. So it's something that is very central to what we do, and we try to think very carefully about the ESG attributes of each of our stocks. And obviously that plays into the overall quality picture of the stocks that we put into Shires and Murray as trusts. This slide just tries to pull together the investment process we have for these trusts. So we start off with the full FTSE 350 market coverage, giving us the maximum chance of finding the right positions and particularly giving us really good coverage of the mid-cap and small-cap spaces within the UK. From that, we generate a list of what we think of as the good quality companies, the ones we think which would meet that threshold and be appropriate for the trusts. We then assess these based on their income characteristics, so the quality and sustainability of cash flow and the willingness to pay out dividends over time, and we review those as a income product group with 5 income managers. Those stocks which have the quality and the right dividend characteristics are the ones that are really suitable for Murray and Shires, and from that we try and build an appropriately diversified portfolio, and then obviously enhance that with the option writing program and have a process of continuous review to try and make sure that we are still invested in companies that are good quality, are not overpriced, and can deliver a sustainable level of income going forwards. So hopefully that gives you a pretty good idea of what the trusts do and how we go about delivering the outcomes. I now want to talk a bit more about markets, and I thought probably interesting to start with a bit of a review of 2020 because it was such a crazy year, frankly, for so many reasons, but for markets as well. And that was particularly the case for income funds. I think Pascal said at the start that it was a tough year for income, and that's very true. The chart here shows you Link's expectations for UK dividends last year. And by the time we got to the end of the year, 45% of companies had suspended payouts and dividend expectations were down about 50% from the start of the year. So a really meaningful cut to income, and we'd seen income retrace back to where it was a decade ago. So managing income funds with the primary aim of sustaining our dividend payments, it was certainly not easy last year. And you would have seen that the income sector in the UK has lagged for a few years, and it obviously had a pretty weak year last year. As a manager, the main decisions we had to deal with were dealing with how we respond to dividend cuts from the companies we hold, and also trying to find some opportunities in the market. So this slide just tries to show you how we responded last year within Shires. And when we think about the dividend cuts, we would kind of put them in three different buckets. The first one, and probably the easiest to deal with, was when companies suspended dividends because the regulator asked them to. And in the UK, that was primarily the banking sector. Now, our view when this happened was that the banks were actually in a pretty good position. Capital was very healthy. The banks have been, are in a much stronger capital position than they were going into the last crisis. And the action by the government to support the economy meant that probably actually they were going to come out of this crisis pretty strongly, and we were going to see dividends resumed at the end of the year. And that's broadly what we've seen. I think every UK large cap listed bank has actually grown its capital position over the last year, despite such a short, sharp recession. Standard Chartered is a good example of that. When we held in Shires where dividends were suspended, but we had a high degree of confidence that they'd resume this year, capital positions looked very strong. And the reasons we like that bank, i.e. exposure to higher growth Asian economies, and still remain in place. So we retained that position and actually topped it up a little bit through the year. And we've seen dividends restart from last week and buybacks resumed. So that's a fairly easy one to handle. And where we've got that kind of temporary shortfall in income, actually for the trusts, it's reasonably manageable because both of them have very material revenue reserves, which we can use if we need to in 1 year. The second one was where we saw really sharp temporary cash flow impacts for the companies. And an example of that is Euromoney. So it's a business information and events company. And last year, when all events were suspended, obviously you had a very, very sharp hit to cash flow generation in the year. Dividends were suspended, quite rightly, and we needed to take a view as to what to do with this one. It was one that was held in Murray and wasn't held in Shires at the time. But our view is that Euromoney is a very good quality company. It's got a very good management team and a good track record of growth over time. So for Shires, we took the opportunity to start a position in it in June of last year, and it's recovered very well as the market has recovered in the last few months. It was up 70% by the end of the year, and we're hopeful we'll see dividends come back soon. And as their end markets normalize, the quality factors that have made that company a good one in the past will come back through again. The third bucket is actually where the change is a bit more structural and where we have to consider that maybe the quality of the company is downgraded. So an example for Shires here was Cineworld, and the pandemic really hit Cineworld at exactly the wrong time. It had just gone through a really major acquisition and taken on a lot of debt, and therefore it wasn't really set up to handle an environment where it couldn't open any cinemas. And that's one that's obviously been a bit of a struggle. We sold it last year, taking the view that even as markets reopen, we would expect the company to come out with a lot more debt on its balance sheet, and the ability of it to deliver a sustainable income is definitely downgraded. And that high debt makes the financials weaker and downgrades the quality of the company. So for us, time to move on last year. In reality, actually, we would have been a bit better to hold on to Cineworld. It's rallied with a lot of the recovery names in recent months. But we have to kind of stay true to what we're trying to do here. We want to own quality income generating companies. And if something doesn't fit in the portfolio, it's time to move on. So what I feel about last year is that actually it was a tough time for income, but it was also a time when active management could really make a difference to performance of investments. And I've tried to show the difference here between how Shires performed and how the benchmark performed. The chart on the left just shows you the FTSE All-Share, and through the course of 2020, you can see the index price being the light blue line and the dividend per share 12-month forward expectations from consensus in the dark blue line. And the benchmark got to the end of the year with dividend expectations troughing in August and a mild recovery, but dividend expectations were still down 40% year on year. In Shires, because we have a bit more fixed income in the portfolio and because we can be active about what we hold through the course of the year, we were able to protect income to a much greater extent. So you can see there the dark blue line, which is our FY21, so March 21 income projections, fell as you would expect. It's impossible to avoid income cuts in this market, but as we took action, they stabilized quickly and started to come back up. And by the end of the year, we were looking at dividends down about 13% year on year. So that's about a third of the impact that you've got from holding the all-share index. And I think a good mark of how resilient the portfolio can be, how investing in the quality companies that we do protected them from having to cut dividends to the same extent, and also the fact that active management could turn that dividend expectation around. The next few slides just give you a quick snapshot of performance over the last few years for Shires and for Murray. Starting with Shires, what you can see is NAV went down 6.5% last year in the context of a market that went down 9.8%. So it beat the market by 3.3%. If I'd put on the slide the UK, the open-ended UK equity income sector, which is a true comparative, then that performance would actually look substantially better because UK equity income underperformed the market. And if we go back over 3 and 5 years, you can see the trust has delivered a very decent outperformance to the benchmark over that time. Again, those numbers would look better if you compared it to a equity income sector. For Murray, again, another strong long-term track record of performance. It actually outperformed the benchmark by 4.5% last year. And again, as you go back over a 3 and a 5 year period, you can see a decent level of outperformance compared to the market. So turning on to markets just now and what we're seeing at the moment and why we actually think it's an interesting time for UK equities and for this kind of quality income approach in particular. 2020 looked like a really strange year. Hopefully we'll never see another year like it. But one thing it did was actually exacerbate some trends in equity markets that have been pretty persistent for a long period of time. The obvious one of them is the growth versus value performance. And what we've seen driving that for the last 30 years indeed is the decline in bond yields over time. So I've shown it there as the generic US 10-year bond yield just declining pretty consistently over the last 30 years and reaching a really low level in 2020. And if you think about how that impacts equity markets, it effectively lowers discount rates and therefore benefits growth over value stocks. Last year, you also got the combination of a real risk-off environment, with the pandemic causing concern and uncertainty and causing equity investors to really cluster into some of the lower risk growth stocks in the market, which meant that growth outperformance versus value really stepped up again last year. And generally, as you would imagine, it's not a great environment for income and for yield because higher yielding stocks tend to skew slightly towards value. And it was also an environment where obviously we got the dividend cuts, which didn't help yield. The chart here just shows you how yield and growth factors performed last year. So one thing we look at quite a lot is quant output and quant data to try and tell us what's performing well, what factors are driving market performance, and try and understand market performance in a bit more color that way. What this shows is the blue line being dividend yield performance in the UK last year. So effectively, if you'd bought higher yielding stocks. And you can see it was a pretty tough year all the way through the year, even into the end of 2020. Green is growth as a factor, and obviously that performed much better last year. Now, that gives you a bit of context for what's happening at the moment. And this chart, I still find a fascinating chart, is what happened on the day that Pfizer released the first COVID vaccine trial results back in early November. And what it shows you is basically the factor performance on that day. So how growth and momentum, quality and value performed within equity markets globally. And on a normal day, you wouldn't expect to see that much dispersion between factors. The left-hand side of that chart where you've got 4 lines moving together is pretty much what you'd see on a normal day. But when the vaccine data was released, what you got was this absolutely wild dispersion between factors. And genuinely, I've never seen a day in equity markets where you've had such a sharp move like that. Value up 4% by the end of the day, and growth and momentum underperforming, growth down by momentum down by 6%. So a real sharp reversion in market trends on one day, which is something I've never seen before. Now, obviously that was just one day, but we've kind of seen that carry on through to this period of time, and you can see that in sector performance within the UK equity benchmark. What you can see on this chart is the dark blue lines being performance of the different sectors in the first 9 months of last year. And if you took the time to go through the sectors, you kind of see the ones you'd expect. So oil and gas, banks, the more economically leveraged sectors, cars, performing really badly. So they're over on the left-hand side. What we've seen since October and since the vaccine update is that investors are much more willing to look through a short-term period of uncertainty and start to anchor on estimates and company expectations when the world gets back to normal. So we've seen a pretty fair degree of reversion in sectors and a rotation back into the more value-weighted sectors. And those things that performed particularly badly in the first 9 months have been the things that have performed generally particularly well since then. And we can see this in the large macro factors as well. You know, the US 10-year chart that I showed you before for the last 30 years is on the left here. And what we're seeing is since the middle of last year, a noticeable pickup in bond yields. And that flows through to equity markets and drives a relative outperformance of value since that point. The right chart just shows you inflation expectations. And again, after a really sharp drop in last year, we've seen inflation expectations come back up again. And that combination of rising bond yields and rising inflation expectations is generally positive for value and to some extent positive for yield stocks. It's also relatively positive for equities over bonds. Now, what I'm trying to say with these charts is not really that we're going to go from a regime where growth outperformed and buying long-term growth stocks was the answer, buying consumer staples and tech, into an environment where actually the reverse is true and everyone should buy value. But what I think it does mean is that we've gone from that period where you could just bet on bond yields going down and discount rates coming down to rise equity values into an environment where investors need to be a little bit more intelligent. We need to work a bit harder and we need to try and find stock-specific bottom-up reasons why companies are going to outperform, because we don't have that clear style bias driving markets that I think we've had over recent years. The other really persistent trend we've seen, or persistent certainly since 2016 in the EU referendum, has been the UK underperforming. So in a sense, it's made investing in UK income quite tough. The UK, it's obviously suffered post the referendum. There's been a degree of, I think, nervousness about how the UK comes out of the EU, how the Brexit deal is shaped and what that means for the country. And we've seen that with a relatively weak currency, and we've also seen it with things like a real lack of business investment and growth from some companies. Now, the Brexit deal has obviously been completed at the end of last year, and I never thought I'd say Brexit would end up being a sideshow, but it has been to some extent. And although the deal wasn't particularly conclusive, it at least puts that period behind us. And it's been a period where the UK market has underperformed the EU by about 25%. It's underperformed the US by about 80%. And the UK comes into this year on a pretty material valuation discount to other developed markets. The reason why Brexit was a bit of a sideshow is obviously because COVID-19 continues to dominate market trends. And actually, this year, it's working in the UK's favour, because the chart on the left there just shows you the vaccine rollout progress for all the major countries. And if you look below Israel and the UAE, which are obviously much more concentrated populations, the next line down is the UK, well ahead of any other developed economy. And it gives the UK a really good chance of getting back to normal and seeing the economy recover quicker than other countries. And whatever you think of Brexit, actually, it's been one instance where the ability to move separately from the EU has been useful and gives the UK as a market an advantage over the EU this year. And you can see the response in sterling versus US dollar on the right-hand chart, with the currency going up quite nicely. Now, other economic data from the UK is also pretty supportive. You can see the unemployment rate on the left there, and it has remained pretty benign compared to previous recessions. And the really amazing chart on the right there showing the household savings ratio at a level we've never seen before. And that is money in people's pockets, which will hopefully accelerate a recovery as restrictions are lifted in the second half of this year. Last point on UK equity income and why it's attractive. You can see here bond yields in the dark blue line and the UK equity market dividend yield in the light blue line. And despite dividend cuts last year, which hopefully will normalise and come back over time, that gap between the yield you can earn on equity and bonds remains near a really high level. Equities, of course, also have the benefit of giving you capital growth and being a better inflation hedge. So that reason to own equities for income, despite recent dividend cuts, really still remains very compelling. And obviously that's showing you the market yield at 3.3%. If I was to plot a trust like Shires at over 5% on there, it would look even more compelling. So one quick slide on how we're positioning in Shires. As I said, what we're looking for here is a really balanced portfolio, and we're not trying to play one style particularly strongly. We try and pick stocks which fit into three buckets. So we're either looking for macro independent growth over time, which then delivers dividend growth, or we're looking for valuation opportunities where we see the scope for some yield compression, or we're looking for defensive exposure and really resilient income. And we try and think carefully about where we're buying stocks and what we're exposed to. The stocks on there you can see are the things we've been adding over the last 12 months, and generally we've tried to deliver a good spread across the chart, but we've probably been added slightly more at the value side over the last 12 months because we're kind of cognizant of the fact that that growth expectation looks a bit stretched and we want to hold a little bit more value in the portfolio. Last slide, just to sum up what we see at the moment and why we see quality income as particularly important. Long-term significance of dividends is really important to total shareholder return. And we think as we get dividends coming back this year and dividend growth resuming, that will certainly remain the case. The idea of investing in quality for income is something we really believe in. It delivers sustainable income, and over time it delivers companies which can trade on a premium rating because of that quality. Those companies with financial strength will be better able to survive the current volatility we're seeing. They'll be better able to take opportunities, conduct M&A and grow faster than the market. And that will give us that combination, we believe, of superior growth and a high level of income. And the UK market right now gives us plenty of opportunities for quality companies with good governance, good ESG credentials, and attractive yields that we're looking for. So I'll end there and delighted to take any Q&A.
Hi guys. So a fair few questions have come in and I'll get started now. Is there a possibility of preference shares being redeemed at some point, given their costs to the issuer?
Yeah, really good question. And in all honesty, one of the risks that we've got to be aware of for Shires, what happened back in 2018 was a really useful test case when Aviva tried to redeem their preference shares, some of which we hold. And the market reaction and the pushback on that was so strong that they stepped away from trying to do that. And I think the chance of other issuers redeeming preference shares below at par or below market rates is minimal. Yes, they are quite expensive for the issuer, but generally they're a very, very small part of the capital stack for any of the companies we look at. We speak to management teams and treasurers, and we think quite carefully about this because it's important. We don't see it happening anytime soon. The risk for us is that if they were redeemed, it would be at market value, and then we need to find other sources of stable income. But that's something we could do with hybrids or other instruments.
Thanks a lot. There's a few questions about the derivative aspect of the portfolio. With a bottom-up high conviction approach, why write out of the money call options that would give away some of the upside, especially if you're positive on the outlook for the portfolio?
Yeah, very, very good question. So we always try and write options in a way that is consistent with our view on the equities. And I'll try and give you an option. I'll give you an example. If we were going to write an option that would result in us selling the stock, and it's a stock we hold in the portfolio, we're happy to hold it, we obviously like it, but we write an option that would sell it at a price slightly above where it's trading today, we're taking a price where we're happy to sell. It would probably be, for example, a stock that has gone up quite strongly in the last year. The position size is looking a little bit higher than we'd like it to be. We'd be happy to trim it at a slightly higher price. Then we write the option. If it exercises, then we've done a trade we would have been happy to do anyway. And if it doesn't exercise, we earn the income from writing the option. It's relatively low volume and it's always consistent with our view on the stock. So it's not when we say it's a low risk option writing program, that is very true, but it does give us that little bit extra income.
Another question that kind of complements that one is, under what conditions does option writing subtract value? And do you have a kind of measure that shows what the average contribution option writing has made to the portfolio over the years?
Well, I don't have it in front of me. We can work it out. It's a little bit, it can give you a slightly false signal of the impact of option writing, because options exercise obviously when, and you then book a gain or a loss on the option. If an option exercises, let's say, to sell a stock that has performed well, and we end up selling it therefore below market price, we book a loss on it. And if you were to go back and see the impact, you would say, oh, they lost money writing that option. But we're always writing that option to sell that stock as an alternative to actually selling it a few months earlier. And if it exercises, then we've sold something at a price above where we would have sold it at 2 months earlier, if that makes sense. So if we weren't writing the option, we would have sold it anyway. And the loss on the option is not incremental to what we would have made from selling slightly early in any case. I hope that makes sense. Generally, what we find is the income earned roughly balances out the cost of any exercise of the options, which is a good outcome for us in terms of enhancing income.
Thanks very much. Can you tell us a little bit about the gearing policy on the trust? Whether you use
so gearing on Shires. Yeah, gearing on Shires is about 17.5% at the moment, and the gearing is there to fund the preference shares. So what we're doing is effectively not taking gearing to enhance equity risk. We're doing it to borrow at a very low rate, down around 1.5% or so, and to fund the purchase of preference shares, which are yielding, even after a degree of yield compression, in the mid-single digits level, so 6% around on average. And given the preference shares don't carry a lot of capital risk, it's quite a nice low-risk way of borrowing at a low rate and earning a high level of income by investing it somewhere else. So that's how you should see the gearing in Shires.
Thank you. Some questions about the impact of COVID. And do you think the political pressure on the winners from COVID is likely to restrict their ability to pay dividends once the crisis is over and they're making things back to normal?
Yeah, that is a good question. If I think about the real winners from COVID, then in the UK market, they tend to concentrate in lower dividend paying sectors. So they tend to concentrate in tech, some consumer staples, but there's not a huge weighting to that. You can point to some winners like Netflix, for example, or US listed tech stocks, where I think there can be some regulatory pressure on those names, and there can be some concentration risk about them. In the UK, we don't actually have a lot of exposure to companies that have been real beneficiaries of this, which has been perhaps a negative over the past year for the UK market, but it's probably a good thing going forwards. And within the portfolios, particularly because the beneficiaries tend to have been lower yielders, where you would be relatively underweight. The trick now, I think, is finding names which can benefit, and that probably hasn't quite been understood yet. So we've got to, you've got to work hard and find those second derivative beneficiaries.
Another question on dividends and sort of companies paying them is, you've got holdings in Astra and Glaxo in the top 10. Do you think once things are on an even keel, dividend growth's trajectory will remain the same, or do you think it will be a different trajectory?
So two very different companies, obviously in the same sector. Glaxo is, I think, in a slightly unique situation because it will, over the course of the next few years, spin out its consumer business and effectively split itself in two. And as it does that, the overall dividend paying capability of the stock, I think, will go down. So we will see a rebasing of the dividend at some point in the next few years. That's already kind of in the price. The headline yield now is over 6%. So it's an attractive yield, even if it is cut to some extent. Astra has for quite a while paid a dividend perhaps above its capability as it's waited for its R&D pipeline to come through and translate into cash flow. And it's now getting to the point where cash is coming through, the cash delivery is better, and the ability to hopefully increase dividends over time is coming through. It's not a natural dividend paying stock because it has this great demand to reinvest into R&D to maintain its pipeline. But whenever we meet management, there is a commitment there to maintaining and hopefully growing dividends going forward, and I think that continues.
Thank you. What proportion of future dividends paid by the trust itself will be paid from capital reserves, if any?
Yeah, that's a kind of a crystal ball kind of question, isn't it? If I look at Shires and I look at this year, then we're effectively covering about 90% of the dividend requirement out of income, so about 10% out of capital. And to put that in context, the revenue reserves as they stand cover about 1 full year of dividend payments, so we're very well covered. What we want to do is obviously fairly quickly close that 10% gap and get back to a position where we're not paying out of capital, we're paying out of income, because that's where we want to be. We're not selling things to pay dividends. And I think there's every opportunity that as we see dividends come back next year and as we do some mild tweaks to the portfolio and just try and maximize income a little bit, we close that gap within the next couple of years. So I'm hopeful we're not paying out of capital for longer than a couple of years. And where we are, it will be a relatively small portion of the dividend.
Smashing stuff. Quite an interesting question here, quite an unusual question, but a very topical one is, have you taken any steps to ensure diversity of background, expertise, gender, etc. on your team to challenge assumptions and to push back against groupthink?
Yeah, it's a strange question, but it's a good question, actually. So what can I say? You could look at the slide of people. We've got a pretty good gender balance in the UK team, which certainly helps. And in terms of diversity of background, I think the nice thing about fund management, and this probably goes against a lot of evidential work about fund management being populated by white middle-aged men who've been to public school, like myself, but it attracts people with a lot of different backgrounds. You know, you get hopefully bright, interested people who care about capital markets and want to learn about investing join. And that's what we see coming up from the bottom. Our graduates are really quite a diverse mix by gender, background, ethnicity. And I can tell you in ASI, there's a very strong push to encourage that. So I'm pretty optimistic about having the right mix. And one thing I can tell you is that the diversity of views and the debate we get in a UK equity team is always very good. You know, it's a real mix of people and views, which is, I think, what you need.
Can you describe the mix of market caps in the portfolio and why that is the case? Is it deliberate or is it just where you find the dividends?
Yeah, so we'll be skewed towards mid-cap with a size bias that is below the market average. Within the UK market, if you want to deliver income, then there is a necessity almost to hold some of the large cap names. So Glaxo and Astra we've mentioned, the oil majors, the miners, they are good sources of income, and most of them, with the exception of the oil majors, have been resilient sources of income through the pandemic. So I think you need to have that large cap exposure. What we find is where we can add the most value, where we find the most interesting investment cases, and where we find the difference to consensus is in the mid-cap space. That's where, you know, having sector specialist analysts who really know their sectors, having really good company contacts throughout the year adds a lot of value. And so hence the mid-cap bias for us.
Brilliant. Last question, probably the hardest one you'll have to answer. What are the major risks of the fund over the next 2 years?
So if I think about major risks, I mean, both of these trusts, we take quite a risk-aware approach, right? And we can really see that over time. They've outperformed the market substantially in down markets. So when I think about the main risk, it's really actually that the market goes up and we get an environment which we've seen in a few days in the last month, where actually you have that kind of dash to trash, where the lower quality names, the most volatile things on low valuations outperform. And in that environment, our exposure to that will be lower because those companies generally aren't yielding anything, so we probably won't own them. And they're generally lower quality, so again, it's another hurdle to us owning them in Shires and Murray. And in that environment, performance of these trusts could lag the market. What we've got to remember is that we are trying to be long-term, and the most important goal is that delivery of sustainable income. So don't get carried away chasing a value rally too hard. That's probably what concerns me, trying to find a way to get enough cyclical value exposure in the trust while maintaining a commitment to quality and to income.
Thank you very much. I'm afraid that's all we've got time for now. We have Rafa in 10 minutes, so we've got to trot along. If you've not registered for that, there's still time to do so. You'll find an article on the website homepage allowing you to gain access to that session. All that remains for me to say is thank you very much for joining us, and thank you, Iain, for taking the time to talk to us. Thanks.
Thanks very much.